Welcome to Johanna Chua. She's Head of Asia Economics and Market Analysis for Citigroup Global Markets. Asia, Johanna, thanks very much indeed for joining us.
Hi, good morning.
You saw this trade number.
Yes.
I mean, it's widening. Okay, you say it's July, but I think that's the most recent data we have. What does it tell us?
Well, first of all, the Chinese July trade data comes on the heels of both Korea and Taiwan also reporting better than expected July exports. And that kind of highlights our view that going into before the S&P downgrade, actually we were already seeing a recovery of economic activity in the U.S. But having said that, this was July data, and now we've got the S&P downgrade, we've got the financial turmoil. So obviously there's going to be more growth risk going forward following that July figure. The other important thing that it points out is that news came out after yesterday. We also saw a little bit of weaker than expected retail sales number and IP growth. So despite exports doing better than expected, it doesn't change our view that probably for this year PBOC is done. I mean, we don't expect any more tightening. And in fact, if anything, the bias is towards more selective easing of policy.
Well, it is tightening in a way already. I mean, we've just seen the yuan hit a 17-year high, and this is after that Fed statement coming through. Now, that does a job partly for it anyway.
So I think the policy mix is going to change. I mean, clearly with the Fed committing to near zero interest rates until at least mid-2013, I mean, it makes it very difficult for any central bank in Asia really to use interest rate policy at this point. But of course, inflation is still a lingering issue. I mean, it's less of an issue now vis-a-vis the sharp correction in commodity prices, but certainly some of the willingness to let the currency adjust rather than use interest rate is probably going to be the policy bias for a lot of central banks.
Right, so where does yuan go? I mean, where does the RMB end up in the air?
I mean, we're still expecting about annual appreciation of about 3 to 4%. So we're still continuing to call for a further appreciation of the renminbi. And the other interesting point to point out is obviously with the downgrades that's happening in the developed markets, the continued accumulation of reserves of a lot of central banks in Asia entails a cost. The cost of capital loss because of the less desirability of holding the sovereign debt, and that obviously has an impact.
It doesn't
on
have a choice.
Banks.
They got to hold it.
They have to hold it, but at the margin, perhaps the trade-off of continuing to accumulate a lot of reserves by continuing to intervene very, very aggressively in the FX market, risk-reward may be slightly waning towards a little bit more appreciation of the currency. But I have to warn you that obviously, even though we are seeing a bit of appreciation, I mean, given the potential risks for exports going forward, I mean, I don't expect a big sudden float of the currency. I still think that the appreciation will be very gradual.
20% over the last 19.5%, if you want to be a pedant, over the last 5 years. That's how much appreciation we've had for the RMB. So we're seeing maybe 3-4% yearly, I guess, is about right and in keeping with what you're suggesting.
Maybe 4% at this point, yeah, roughly.
Right, okay.
Right. Yeah.
But I mean, what about growth? How much does it slow down?
Okay, well, if you look at the first half of this year, actually growth was better than expected in China. We've only seen a little bit of weakness a little bit recently, but overall this year we're still expecting China will grow about 9.2% and slow down to about 8.6% by the end of the year.
Jonathan,
let's talk about the economy here for a second.
Sure.
Maybe step away from the markets. When the market's panicking because of the economy, we got the statement out of Ben Bernanke yesterday.
Right.
Number one, were you surprised? Number two, do you think this really means much to the market? Does it change anything?
I wasn't really surprised. I mean, it was clear that the market was asking the Fed to do something to soothe the
They were potentially talking about QE 3, 4, and 5.
Right, and we actually, our house view...
They didn't get anything.
Well, our house view was we weren't expecting QE 3. We think still the barrier is still a little bit high for QE 3 at this point. But having said that, Bernanke did keep the options open, and I think that was enough to kind of soothe the market.
I mean, this is the usual thing, isn't it? He just comes up, his helicopter Ben to the rescue, and that was it,
But I think what is new is that there's a commitment on the timetable. They said at least middle of 2013 to keep rates very low.
But the idea also is that if the economy were to slide back into recession, he would not be able to raise rates in any case anyway. So if I read between the lines, is he saying that the economy is going to remain weak for an extended period of time, and therefore we will have to keep rates basically at zero? And okay, let's bring that over to Asia. What does that mean, I guess, for the Asian economies? We've talked about the currency effect here in Asia as well. Does it have a positive or a negative impact?
Well, clearly Asia cannot be immune to a U.S. slowdown, and you can see that there's varying impact. So the more open economies are likely going to be more vulnerable. So today we just got the revised 2Q GDP number out of Singapore. It was better than expected, but overall for the full year, I mean, even MAS lowered their GDP growth or narrowed their GDP growth forecast this year to 5 to 6%, and we just downgraded our GDP growth in Singapore from 7 to 5.7. And the other more cyclical economies are probably going to be a little bit more vulnerable, cyclical or open economies.
So are you saying that things are less bullish than they were yesterday? Am I reading that right?
Well, definitely growth expectations are less bullish. We've actually, the fact that we've downgraded our U.S. growth outlook is also going to have an impact across Asia, very unevenly. So the more open economies, markets like Singapore, Taiwan, Malaysia, Thailand, they could be a little bit more vulnerable. But China, Indonesia, India are a bit more domestic-driven economies.
What about Korea? Do you consider Korea an open economy?
Korea is also a little bit more open as well. Not as open as Singapore, but certainly on the open end.
But when we look at, we were talking about this earlier, when you look at the Chinese export numbers, they've got this trade surplus now. What is it? Nearly 31.5 billion US dollars for July. And exports very strong. What is that telling us about the main export destinations? So we're talking about, of course, Europe being the biggest one, the US being the second biggest. Could we see US growth surprise on the upside as a result?
Well, the problem is that data was July. So it's a little bit of a backward-looking data. And in fact, we already saw a rebound in sort of auto sales, some consumption data out of the US in July from the very weak numbers around June. And so if you look at the July data, as I mentioned to you, China, Taiwan, Korea all surprised on the upside. But look, there's a game changer now. I mean, the downgrade of S&P, the turmoil in the financial markets kind of changed the calculus.
Why is that a game changer to you?
Well, because it's about confidence.
Right.
I mean, what drives recovery and what could impact consumption and investment is confidence. Now, if the Fed Bernanke's, the policy overnight helps soothe confidence and people will start spending and investing again, then we should have a pretty okay recovery.
You brought up a good point, the last couple of days where, we show the markets, we show the declines, and we basically talk ourselves into this potential recession that we're so worried about. I mean, is there... How much of an impact is that sort of adverse effect loop that we call it?
Sure. I mean, look, we don't expect a recession, but clearly if confidence is very fragile, if something bad happened, then it can be a self-fulfilling kind of prophecy. So I think that's why it was very key to see what policymakers did, and I think it was good that Bernanke gave something to the market.
You think that's enough, right?
Well, it's hard to tell.
What more can just saying a little thing like that? I mean, just coming just saying
what more can they do?
And you get this reaction. I mean, it just shows this was just a confidence-related thing rather than anything to do with the fundamentals of the U.S. economy. Nothing's changed since last Friday. Nothing's changed since Friday, since the downgrade happened. From before there, the U.S. economy has not changed materially. It's not gotten any worse or improved. It's the same.
But it's about expectations and the fact that people now expect that the Bernanke will be more proactive or could use policy tools if things slip further, obviously impacts decision-making of consumers and businesses. And that impacts the economy.
Here's the other scenario that Bernanke's painted himself in the corner, too, as well, right? What if inflation starts to pick up at the end of, say, this year, early next year?
We haven't seen evidence of that.
For whatever reason, say next year, and Bernanke has now said, well, we're going to keep rates virtually at zero.
Yeah, but he just turn around and say, well, sorry, the situation's changed. I'd be really imprudent if I didn't do anything about this.
That's a different conversation.
I mean, when the S&P downgrade happened, what changed is the fiscal flexibility. I mean, there's really the policy flexibility to use fiscal policy has basically been taken off the table.
Yeah.
So therefore, monetary policy has to be a little bit easy for longer when fiscal policy has to be a little tighter.
Yeah.
So that's why, I think, overall, even though people worry about inflation, it's still a lingering issue, and that's why there's just still a high barrier for QE3. I don't think at this point, given the growth headwinds, I don't think inflation is a big concern at this juncture.
Oh, no, let me jump in about QE3 because I got to ask you.
Okay.
Yeah, I do want to talk about QE3 because I talk to a lot of investors day in, day out, and I would say the majority of them, 70%, believes that there is going to be some sort of stimulus package, maybe not bond purchases, but you replace the shorter-term ones with longer-term maturity bonds, or you even go in and buy corporate ones. Why is that so? I don't know. It just seems like it's off the cards for Citigroup.
No, it's possible.
Right.
We definitely.
That's not your scenario. That's what you said.
I mean, in the meeting yesterday, we weren't expecting it. I mean, we think it was a little too early yet, so conditions aren't that bad yet for Fed to sort of jump the gun and use QE3. But look, I mean, we've also highlighted a risk that further accommodation is possible.
Right.
So we'll have to see how things
Give me a
pan out.
probability, though. I'm curious. I would like to know probability first.
The long-term rates are at 2.25% right now. So the issue isn't about necessarily the bond yields getting lower, which is the original idea of QE2. It's really about getting the private sector to spend their balance sheet.
Right. And, but the question is, if people are still very uncertain about the fiscal overhang and the fiscal adjustment, then people are going to be a little reluctant. And there's been obviously a lot of political criticism as well of using QE3, because does it really generate jobs, or does it just
that's what Todd
raise
was saying
prices?
from Soc Gen to me yesterday, saying they'll only do it if they can actually add a jobs package right next to it. So that you have firm job creation rather than spending money, printing money, should I say, and then finding that, well, we're finding it all coming here and in the form of huge walls of liquidity.
We had the industrial production numbers out of China yesterday. We had the strong and expected CPI numbers. Where are we in the cycle in terms of the economic situation for China now?
Well, I think we are slowing down for sure. I mean, we've had first half was actually pretty, stronger than expected. Going into the second half, probably as some of the lagged impact of monetary tightening start taking effect. At the same time, export growth should slow down from the pretty fast pace we've seen so far up to July. That should obviously have an impact. So by the end of the year, China's growth should be about, maybe in sort of the mid-8s, sort of below 9% definitely. So we're forecasting about 8.6 to 8.7% by the end of the year.
Yeah. And house prices?
Well,
what's the danger?
In China or in Asia in general?
In China,
well, in China, we've already seen. Obviously, some of the property tightening measures already having some impact in some of the top-tier cities. So we are expecting, obviously, a correction. But we don't expect a major, property collapse or something like a downturn or hard landing because of the property market.
People are waiting for a hard landing here in Hong Kong, aren't they, to perhaps get off the housing ladder?
Buyers are.
Yes, certainly. Yeah.
But look, the reality is, real rates are still very, very low.
And it will be for a long time. Apparently.
Exactly. And it's not like people don't have jobs. People have jobs. There's income growth. Job markets are quite tight. So therefore, if inflation is still, expectations are still there, people still want to buy assets. But I do think we are not seeing, yesterday there was sort of an auction in Hong Kong, right, which was had a disappointment.
Only one person took part in it, though.
So, there could be.
Shot him, wasn't it?
Yes.
Well, far away.
Obviously there could be, some people are there could be some correction. It's possible, certainly, but real rates are still very low. So I don't think we have a hard landing.
Johanna Chua, thank you so much for joining us.
Can I just say that I enjoyed the evenness of the genders here?
What do you mean?
Yes.
Yeah. You were welcoming
Thank
a certain
you for that,
hormone.
Joanna. I appreciate that. You can come back anytime. Johanna Chua of Citigroup. Now coming up.